Good morning and smell the coffee. Welcome to IG's early morning call on IG Live on Monday, the 20th of March 2023. We've got so much to get you through. Let's take you through the headlines first. Relief over the Credit Suisse deal crumbles. Attention turns to the bond market and the risks there. A case for a Fed interest rate pause gains steam as global central banks bolster cash flow around the world. And Bitcoin nears a 9-month high. Turmoil in traditional banking sparks a digital asset rally. Now, on that note, let's quickly check on the VIX. This is the volatility index, of course, a fear gauge. It's looking like it's creeping higher there, as you can see, as we head into the European market open. Just 30 minutes to go now until that open, and this is how the pre-market is looking, showing you the France 40 there, or the CAC 40 rather, looking slightly lower. That's the pre-market view. Anyway, the German DAX, or Germany 40, same picture there, slightly lower open indicated. It's still 30 minutes to go till the open, might I add. And the FTSE 100, a similar picture there as well. Futures indicating all these slightly lower opens after European shares recorded their worst 5-week in 5 months on those banking crisis jitters. Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab, said that central banks have essentially done the right thing in putting an effective backstop in place. It's just going to take some time, Kleintop said. Now, overnight in Asia, it's also a very interesting picture for you. Let's take a look at the chart, and it's up, all down arrows, as you can see. Nikkei down 1.4, Hang Seng settling down around 3.2, and the ASX down around 1.3. Let's take a look at the Wall Street close as well, because it was a very, very volatile week. The arrows also all pointing down. The S&P 500 down more than 1%, along with the Dow Jones Industrials. They all ended on a sour note as fears about contagion snowballed dramatically after the closure of 3 US banks last week. And of course, those liquidity concerns about Credit Suisse in Europe. Speaking of Credit Suisse, let's take a look at that now, because Credit Suisse has been hogging the headlines all weekend. Just to catch you up on some of the key details, UBS has agreed to buy Credit Suisse in a historic government-brokered deal. The Swiss bank is paying 3 billion francs, that's right, 3 billion. That's $3.3 billion for its rival in an all-share deal. Now, this includes extensive government guarantees and liquidity provisions as well. What's staggering is that the price per share is a 99% decline from Credit Suisse's peak in 2007. I'm trying to get the chart back as far as that for you, but you can tell the picture I'm trying to paint there. UBS, well, what is in it for UBS? Well, it gets Credit Suisse's crown jewel, its profitable domestic bank in Switzerland. The question now is what happens to Credit Suisse's risky bonds and those that are holding it. Will this create another wave of turmoil, this time for bond markets? Well, that remains to be seen. Now, to some macro news now. As expected, the PBOC maintained its loan prime rates unchanged for a 7th straight month. The one-year loan prime rate was left unchanged at 3.65%, while the 5-year rate, which is a reference for mortgages, was maintained at 4.3%. This was largely expected, with the economy already benefiting from policy actions taken as China recovers from the pandemic. Also, some breaking news now. We've got some German producer prices. They rose more than expected in February, according to data just released. The producer prices of industrial products in Germany up 15.8% on the same month last year. Poll by Reuters had indicated a rise of 14.5% year on year, so slightly higher than expected. Back to Credit Suisse and central banks now. The Credit Suisse UBS development has meant a seismic shift in central bank thinking and the thinking around what central banks might do as well. The Fed and 5 other central banks worked together on Sunday to boost liquidity in US dollar swap arrangements. This is in an effort to ease growing fears of contagion. Many market watchers say this means the Fed will this week pause its rate hike trajectory, at least until all these problems blow over. Economists, however, believe the Fed might adopt a dual-track policy approach, distinguishing monetary policy from macro-prudential policy. Now, last Thursday, the ECB stuck with its plan and raised its main refinancing rate by 50 basis points to 3.5%. Christine Lagarde couldn't say it more clearly. The ECB is not waning on its commitment to fight inflation. Now, a vast majority, as I mentioned earlier, of economists are now split. Some think that the US central bank will not pause their fight against inflation. Others think they might. Those that think that they will hike rates, they think they'll hike rates by 25 basis points, which would bring the Fed's benchmark rate to the 4.75% to 5% range. That said, expectations of a 50 basis point increase is now gone. Remember, just a week ago, it seems a very long time now, Jerome Powell signaled he was ready to hike rates faster if data supported the need. Fed funds futures now show a probability of a pause of around 14%. Now, plenty on the UK macro calendar as well. We've had inflation on Wednesday, plus the Bank of England also meets on Thursday. Economists think it'll push through yet another rise in rates, despite the shenanigans on the global banking scene. But of course, all this was before it spilled out into Credit Suisse and, of course, the rest of Europe as well. We also have retail sales numbers on Friday, so that should give us a better reading of consumption and how investors and shoppers alike feel about buying more discretionary and non-discretionary items, and that could also feed into the interest rate expectation game. Now, plenty of results out as well. Let's give you a quick snapshot of the ones to look out for from the UK and the US this week. We've got Kingfisher, Fever Tree Drinks, which is a rather interesting stock because it, of course, benefited during lockdown when people were drinking perhaps a bit too much. And then its shares have been hit by the supply chain crisis and also higher material costs in things like glass. And we also have numbers from JD Wetherspoon. From the US, look out for numbers from Nike and also General Mills. Now, I also want to have a check on the commodities market because we have had some impact there from the banking turmoil. Here's a look at crude for you. Oil prices continue to fall a second session. This is as the banking concerns persist. Now, the worry for traders in oil is that the banking sector fallout could lead to a recession, which will in turn potentially hurt demand. And as I mentioned earlier, Bitcoin, one to watch because it has been trading furiously high, as you can see there, near a 9-month high as the bank turmoil in the traditional banking space sparks a rally in the digital asset space. Bitcoin rising some 26% last week, and it's up more than 35% in the last 10 days. The momentum is all driven by liquidity, says Mark Tilson from Matrix Port. Well, that's it for now. Before I let you go, I am going to remind you of the key times to tune back in for IGTV. We've got, of course, charting at 10:30. And also, if you want to hear more about the potential for this banking crisis to unfold and what the emergency or red flags are, have a look at my interview both on podcast and on the IG platform with Bill Blaine from Shard Capital about how this could potentially move into the bond markets. Until then, I'm Angeline Ong. Thank you for watching IGTV.
For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.